So today in the market, I guess you guys saw what you wanted to see, what you needed to see. It's kind of what I described that was gonna happen. Palantir going up. At first, what looked like to be just 15%, then it creeped to 22.5%, just about, and crashed back down. Not really crashed, but tapered off some, gave some of the gains up to 16.41%. That is where we closed for the day. The after hours, it traded even higher, back up, retraced by 1.67%. These are good things, right? This is kind of what I expected. This is what we explained. We didn't know the specific timing, but there are enough people around the web that have brought attention to Palantir as a stock. This is the volume that I was talking about. This is the pump up phase. We'd seen it with a bunch of other companies before. This particular video I'm making for you long-term holders. Those of you guys that have decided early on that you were going to hold on to the stock for however long, to see where it takes you. I have to do this video on the side because some people tried to correct me and saying, oh, well, there's a lockup period for this stock. That's kind of true. So that takes away some of the dilution expectation, right? So that was one of the concerns, and that's also the concern we're going to be talking about and why that's even important for this video. I know you think that you know why. I know you think you know how to handle that situation, but I don't believe you because I've talked to so many people that said that they were long-term holders, they bought through the pump, and something ended up happening. So, yeah, we talked about there being a day where there was going to be a 20%, 15 to 20% return intraday. That happened today. It happened expectedly unexpected, right? I mean, could we have gotten any better than that? The other thing I wanted to say was that this is not the channel. For you new subscribers, thank you so much for joining us. I'm glad to have you here. I hope that I can do as much of whatever it is that you believe this channel is going to suit you to do, right? But I do want to give you a disclaimer. I'm not going to tuck you in at night. I'm going to show you how to make your bed so that you cannot have a dependency like other folks do on YouTubers to find out what it is that you need to be doing, what it is that you need to believe. I'm going to give you the tools to make your own assertions and be confident in your belief, or throw darts and do it blindfolded and then see where it ends up and say, oh, yep, there's my opinion. That's not what we do here. Everything we do in this channel is based on reasonable assumptions and with the most information we have, the most relevant information that we have to show us where we're going. That goes for fundamental analysis. That goes for technical analysis. You saw how my hand kind of went out of frame. It's like, well, I've got to bring that back in here. But that goes for both of those worlds because both of those worlds cater to almost 100% of the people that delve into stocks. And this is a stocks channel, of course. There are a lot of imitators out there that are going to claim, I have a Harvard education or whatever, or I've been trading growth stocks for X number of years. You've been trading. Anybody can say they've been trading for any number of years. That has no bearing on your actual experience or your competency. So that's why you're here with me, because that's what we're all going to make each other better, sure. But I'm going to make you better, more importantly. You can take that to the bank, boy. What do I expect and why am I cautioning you long-term investors with Palantir? This run-up is an ideal time for companies to fundraise. And I've got a perfect example that I'm going to tell to you in a little bit. But the reason why is because it's a fairly new company. They've got a really large growth mission. I mean, they have a ton of things that they can get into and immediately deploy that capital to, right? But in the early stages of this company going public, they really don't understand how to be efficient with that capital. And as you know, I mean, Palantir has been around for, was it 12 years? Was it since 2006, 2004, 2008? I don't remember. It's been around for a while, and it hasn't been profitable that entire time. But we have seen more recently in the past 3 years, tons of revenue growth. And we see that they can close the gap so that there's less losses in the future and more earnings in the future. More earnings in the future and higher growth means that the intrinsic value is going to be higher. That being said, why waste a precious opportunity to raise money in the present? They're going to look at this run-up. A lot of companies treat the stock market like an ATM once they get publicly listed. the stock market becomes a perfect place to issue more shares of stock, to raise more capital. That is what companies do. And so going back on the lack of efficiency, this is where you have to be cautioned. When they raise more capital, they issue more shares of stock, the valuation goes a little bit higher naturally. But the valuation that it goes to actually needs to match what their earning prospects are. How much closer are they to accomplishing their goal? And are they actually being more efficient with their use of capital, dollar per dollar? Even if they have negative returns, are we closing the gap at the rate that we expect? That determines efficiency in capital, even if they're not profitable, because we have to close that gap. There's an expectation. There is a time limit. Everything has time limits in finance. If you didn't know that, you need to know that. You don't, when we say how much money we make, do we give them light year, or sorry, that's not even a, scratch that. Do we give them every 5 years? Do we give them every 10 years? Or do we care about how much money we make in this year, in the year? That's why we give return estimations, because that's what matters in finance. How much of my money will I get back this year? Not I don't want to see 6% over the course of 10 years, because I'm comparing that to an investment that gives me 6% over the course of just 1 year or 2 years. So time totally matters. And if it didn't, then we wouldn't even have to make a decision between one company or the next. So moving along, when it comes to the timing, we have to see that their valuation is appropriate per the amount of returns that they're making right now. That's important. We don't want to delay how long it's going to take for them to close the gap, right? So I think I really just killed the horse on that. That being said, as they issue more shares of stock, somebody already had a tiff with me about a lockup period. Let me just say this. Their lockup is self-imposed. The lockup, for those of you that didn't know, is a period of time where they're not allowed to sell shares of stock. Insiders are not allowed to sell their existing shares that they own. They can't exercise employee stock options, and allegedly they can't issue new shares of stock. That's false. There's no legality in that. That's not SEC enforced. If it's self-imposed, the only thing that has to change is that they have to give you information that they have. Once they give you that information, and usually they wait to the next quarter or whatever to file it with their quarterlies. Once they give you all of the known knowables and all the what they know of the unknowns, then you know as much as they do. They're allowed to do whatever they want. So long as they let you know ahead of time that, hey, we're going to allow employees to sell some of their shares. As long as you have that information ahead of time, they can do it. Voila. So the lockup period is an invisible policy that they impose on themselves. There's no hard lines. That's just how it is. And so why, like I said, why would they waste an opportunity if there's a ton of pumping into the market, into their stock? There's a ton of pumping going on. They would change the policy, of course, so that they can also allow employees to get out of the shares of stock. Maybe they want to remove certain executives that have stock units that they need to get rid of. Well, it's time to sell, and it's time to get the hell out of here because I want to replace you with somebody else that matches this company better so that they can carry us into the next phase. So these are things that happen. I do want to part from this conversation for just a moment. And for those of you that, you're not really long-term investors, what you would want to see, what you do care about, is like we talked about in the last video. I said Palantir is insulated from cyclical events, which is, the market cycles, business cycles, depressions, recessions, that sort of thing. And I said it because of how they're positioned as a company, what it is that they do and who they do business with. Governments all around the world, right? So we saw the Dow Jones Index taper down by not just a little bit, but by quite a bit. And Palantir went up. That intraday negative correlation, where one thing goes up and the other thing goes down, to really prove that they are insulated, I can't base that remark off of one day, off of today. So if you're saying, oh, well, today proved it, it's completely insulated from negative outlook on the market. Today did not prove that. We need actually a longer band of history to show us that there is an actual traceable correlation. One day of data is not as good as 30 or 60 or even 90. So I really want to reinforce that fact that, yes, we're looking out for that. We're on the lookout to see how, on the long term and the short term, how Palantir performs in times where there's a negative perspective of the market. We need more data on that. Going back to the original discussion, I have a company here that I've been analyzing. It's called NNDM is the stock ticker symbol. It's Nano Dimension is the name of the company. I don't know too much about it. I saw it in another YouTube video, and I totally just took it on it because I thought, wow, this is trash. But it offered a great lesson, a great point. This company went up and down in its stock price, and early on, whenever they started publicly being traded, let's go in the 5-year history, and I hope that you're able to tune in with me on the screen. Let me make sure. Yeah, I think we're recording. But let's look at their. Okay, if that's not opening up, I've got it somewhere else. Here we go. So on my Excel spreadsheet, this is a nice and pretty graph of what happened. Let's just go ahead and look at through the years. This was the average market cap right here and also right here. I just have this is starting at 2020. This is starting at 2015. I took this and just reversed it down here, and that's what you're looking at. So it makes more sense from left to right. There you go. So looking at 2015, they had an average market cap of $50 million. Over time, that market cap went up. And in fact, as there was more trading pressure bidding up the price, this company spared no time in seeing that they raised the number of shares outstanding. You can see that right here. Look at shares outstanding right here. So this actually does count backwards. This is 2015, and we'll move this way. Or do I have it relisted somewhere? Oh, there it is. I do. So here, let's go down here. Let's say that in 2015, you owned all 538,000 of those shares. You have 100% of that stock. As they issued more shares to the public, as they sold more out, as the market cap went up, in this fervent buying pressure that made almost no sense, it's irrational exuberance. As that happened, you also owned less of the stock. From one year to the next, you went from owning 100% of those shares to 65% of those shares. The reason why I started off with 100% is because we needed to start off with a factor of 1. We needed a basis year, and we needed a base number. And starting off with the whole pie at some random year gives you this example, and it gives you the same mathematic formula. So it's great, right? From the next year to the year after, we go from 65% to now you own 47% of the stock. You didn't do anything. You did nothing. The company issued more shares around you to raise money. And going back to their financials, let's look at how they use that money. Is this going to load in time? I don't know. Okay, here we are. So their cash flow statement, perfect. We see net losses from 2015 all the way to 2019 each year, and going down, what is more is net cash flow from operating activities. This is essentially their earnings before interest and taxes. It's nearly the same. But we see it's negative, 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 negative. But we also see in their financing activity, they go from, they issue consistently around $14 million, which is about the same average. No, it's more than what their cash flow from operating activities is, what their losses are. So what we're really seeing when we see that is that not only did they lose all of the money that was invested into them, they issued shares of stock into the market. They got paid cash. The cash is then supposed to be reinvested into the company in a way that, like I said, creates more efficiencies. It either narrows the gap of your losses and makes it more likely that you'll have net income in the future. And that has to happen by some factor in order for the price to appreciate or in order for the market cap to appreciate. And if it does not happen, the market cap shrinks because the market cap does not care. The whole value of the company does not matter how many shares of stock you issued, how much money you've raised in the stock market. It's how much of that money has been converted into returns. That is what brings up the market cap. And as you increase your shares outstanding, you should also be increasing the total amount of invested capital in the company. Then that should naturally increase the total amount of returns, not the actual percentage of return. That requirement stays the same. So if you require an average of 15% of return on the invested capital, that stays the same. Well, if the capital you're growing is higher and higher each year, then the total earnings you make off of that capital being raised, should also increase year over year, even though the percentage required is 15%. Well, you're not seeing that here in this company. You're actually seeing them raise stocks, use every bit of it to continue operations, pay employees, pay themselves as employees, and then have a net loss the next year. So they lose almost all of their cash. And that's terrible. So this is what I talked about, early companies having very little efficiency in how they use their capital, but they also waste no time. When they see the stock run up, that fervent buying pressure, and I think it shows up here. Let me see if I can get the 5-year open. Well, that doesn't really show it. If I went back to the 5th year back, you'd be able to see it better. Market cap especially. But anyhow, when you see that fervent buying pressure, they will issue more stock into that. Well, what it does, if you're a long-term holder, then that means that if you front run them raising more stocks or them issuing more shares, there's more people in front of you with more control over the price than what you have. So if you own, say, 2% of all of the shares outstanding, and then they issued 100% of the shares that they already have out into the market, well, now you've doubled the number of shares. You've decreased your amount of holdings to now 1%. You own 1% of all the shares outstanding. If that happens, the market cap should double and maintain being doubled for you to stay in the same nominal amount of holdings that you have of that company. That's a fact. So if the company's worth $100 and then they issue more shares and now it's worth $200, right? That you should expect that. Well, and you go down from owning 2% to 1%, you should still own $2 of the company if that should happen. However, that happening was also during a price run-up, and that run-up was irrational. That's what I caution you about. When you buy into that run-up, while they're also issuing more shares, it then makes your position more vulnerable to all of these other people that can sell, that can create massive amount of selling pressure, greater than what even the value of your stock is worth, even though you saw it go up and up, and you thought, oh, well, it's going up. I'll just dollar average and keep buying more. Well, whenever the price comes back to intrinsic value, you realize, wait a minute, I've been so diluted. I own this much less of the company, even though I bought more stock. I didn't double the amount of shares I owned, but yet they doubled the shares outstanding. And instead of the market cap doubling or staying doubled, it came down to where it only went up by 30%. Well, overall, you lost then. So this is something that you should be on the lookout for, because this is a really big deal for long-term investors. What was something else I wanted to show? With NMD in particular, NMDM, they went from 1 year, last year they had 2.2 million shares outstanding, to the next year having 54, look right here, 54 million shares outstanding. So 2.28 to 54 million shares outstanding in 1 year. Going back to the spreadsheet, let's look at the market cap. This blue line is the market cap. From this year to the next year, look what happened. They went from sub 20 million or $20 billion in valuation. Is that million? No, it's million. To having a value of $160 million in the time that they also issued more shares, probably because the stock price was actually running up too. They didn't want to miss the opportunity to raise money. They got to keep people employed. They got to be able to pay for that. But look at what happened to your share of ownership. It continued to go down by percentage. In 2020, you own 1% now of the entire shares outstanding based on where you bought in 2015. This is a long-term holder. And even though the market cap went up to extreme highs that you've never seen before, the value of which you hold is less than when you bought in. That is the nature of this beast. So I hope that you're still with me. I know I've carried this for a really long time, and I want you guys to learn something from Palantir. I want you to learn, these oddities in being a short-term investor. Technical analysis is going to help you some, sure, but also understand just the raw behavior of people. what people are saying about it in the news. And once you've pretty well saturated what most people know, and you get to a point where volume is pretty much tapped out, you'll find a critical moment where the last bidder is no longer seeing the value in where it's at, or it's just too high for them to buy, to justify buying. The people that bought in sooner will see ahead. They'll say, well, if it's not getting any higher, I have no reason to stay in. When they sell, you see the cascade. I want you to recognize this pressure. And it's coming with Palantir. I don't know if it's going to happen at $30 a share or 40 or 50. I have no idea. But I know that it's going to happen. I'm pretty sure. Anyhow, that pretty much concludes this entire talk, and I know it's been long-winded. I hope you guys really, really stuck with me. I see that I have an average watch time of about 30%, so you'll watch 30% of the video and then you'll get tired, and then watch someone else who's probably going to talk about none of what we've talked about here. And only when you come back, I don't know if you ever even will come back, but you should. You should watch this all the way through, even the next one, and just get every bit of information that you can before we move on to the next video, because I'm going to talk about things as though I've already made my point. And I don't want to keep talking on the same point over and over again, because I don't like that. Anyhow, thank you so much for subscribing. Those of you that haven't subscribed, subscribe, hit the notification bell, and be well. Thank you for watching.